Hello, this is Semantics Research with the Daily Report. With today's core CPI number still blistering hot at 0.6% month over month, we had sell pressure in the early morning and consolidated at the lows all day. The core CPI increased 6% year over year in May, while the headline CPI is up 1% month over month and 8.6% year over year. The 2-year yield rose above 20 basis points above 3%, which was the highest since 2008. With the CPI showing that we haven't peaked, the Fed will be pressured to take action next week and further aggressively tighten to deal with inflation. It appears it will be likely we will go into a recession or even stagflation at this point. It's hard to tell if we are in a recession until the GDP numbers come out, but other indicators such as the Purchasing Managers Survey can give us a read. If the managers are starting to cut down, then it is not a good idea. It is not a good sign, and waiting until executives to state the company guidance in earnings calls is a bit too lagging still. University of Michigan consumer sentiment has collapsed to 50.2, way lower than the consensus at 58.1, which is the lowest reading in history. And the consumer expectations were 46.8 compared to 54.5 expected. The survey stated that the consumers are highly concerned that inflation will continue to erode incomes and think it's unlikely to ease off. While consumer spending is still robust, the deterioration of sentiment can cause them to reduce spending and reduce economic growth. This in turn will lead to recession as the U.S. economy is consumer-based. We have energy prices weighing in on consumers, and 46% of consumers have a negative view due to inflation. Buying conditions have crashed to new record lows as things become less affordable. As inflation is outpacing wages, it will likely cause Americans to dip into savings and take on more debt. The Fed thinks that their effort is working, with no major systematic risk yet, only a few hedge funds blowing up, and credit spreads are widening but not necessarily broken yet. They're also getting rid of speculative excess in long duration, and asset prices are cooling down. Their best case scenario is deflating medium-term inflation expectations, like the 5-year yield goes down to something reasonable like 2.5%. Then you will get a sense that the Fed is being given credit market that they will succeed in the medium term. And the 5-year break-even is still north of 3% currently, and is ticking a bit higher. At this point, they are preliminary content with how they have been navigating, because it has been coming down, but now they have to see how these rate hikes are absorbed into the economy, and this continues to see this the way to go. Because if the lockdowns in China worsen and go into a lockdown regime, that will be almost even worse than the outright lockdown, as it brings uncertainty, as you don't know how to structure your supply chain because you never know where your lockdowns might be. It is not good for the cost of doing business, and it is building cost in. Then you have the decision by the EU to ban Russian crude from ships, which is another factor, and the rebound in base material metals, and the moderation in growth expectation holds then that it is repricing of inflation expectations also. The market may be realizing that the Fed in September may say it is not heading in the right direction and be willing to be more aggressive. The second half of the year may still be like the first half of this year, as the main narrative that the cost of money will be still high. And the Fed will be less volatile in policy, but the market conception of it is more volatile. But the most important thing is what happens next year, and that is the main catalyst to shift sentiments. A lot of the big swings happen with the Fed funds futures rate in the end of 2023. The Fed probably wants an ideal situation where this situation is finally where the cycle is caught up to the and to normalize policy in a lasting way, and this is the point where we get to structurally more normal monetary policy. They're ultimately want to get there, but not sure if and when and how fast they can. They are thinking about how quickly they can normalize. As for their desire to reduce the balance sheet and bring rates to more normal levels, has been a guiding light for them since the GFC. One point some bring up is that the Fed's desire to maintain its credibility will over-tighten and make a policy error to go to go far past neutral, because a lot of these things are out of their control. Or supply-side economics and supply-side stimulus is generally deflationary, and will be removing that. Will take investment out in time when you need deflationary forces. The thing is, the market has been going where the Fed is leading them in terms of investor positioning. The dollar is getting stronger, stocks are going down, and SPY is going down in a trend. And real rates have gone up, and nominal rates have gone up. Another thing is labor force participation is still below pre-pandemic levels, so there is room for some leeway, or if we are heading into some trouble, that there may be enough room for unemployment rate not to tick higher significantly yet. Also, the China situation is interesting, as the global growth is slowing while they're still easing. We saw a nice rally in China stocks, but it's not certain if we can get behind China long term yet, as we see de-risking across markets, and China is still export sensitive. We are seeing a shift from risk to safety. Also, we compare the emerging market versus developed markets. The developed markets are performing better. Also, political uncertainty with Taiwan plays a geopolitical potential risk during this decade or the next one. And we have to ask ourselves what happens if China tries to play Russia. And it seems like Shanghai is going into lockdown again, and this will probably be the case for a while. Thus, the supply chain will be in taters. U.S. interest rate futures price in about 215 basis points in cumulative Fed hikes in 2022, and Fed funds rate of 2.985% at the end of December after U.S. CPI data. And the CME Fed Watch shows a 50% probability of a 75 basis points hike to 25% at the July meeting, as inflation still runs hot. As we can see from the WASDE report, the USDA has cut domestic ending stocks projections for soybeans, while raising the outlooks for corn and wheat. The average farm price for soybeans is increasing, while the average farm prices for corn and wheat are unchanged for 2022 to 2023. We had the Baker Hughes oil rig count increase this week, with 580 oil rigs compared to last week's 574, and total rig count increased this week with 733 total rigs compared to last week's 727. So we can clearly see continuous growth in demand for oil, which is exceeding the supply due to the geopolitical issues of Russia's invasion of Ukraine and the following global sanctions on Russia. Overall, looking at these commodities, we can see record low inventories in agriculture, very low inventories in oil and oil product markets, which are still in a deficit, even assuming you get a demand slowdown from here. And then we have the U.S. federal budget balance come out with a $66 billion deficit, while the forecast was a deficit of $136 billion, and the previous was a surplus of $308 billion. And the fiscal 2022 year-to-date deficit in the United States is $426 billion, compared to a $2 trillion deficit in fiscal 2021. And lastly, we had the Commitments of Traders report come out showing speculative net positions on the ES on Tuesday with non-commercial net short and commercial net long. So that concludes our report for today. Thank you for watching the video, and be sure to check out the socials in the description to stay connected with us. Thank you.